Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing CMHC's housing market assessment. This is a quarterly report they put out to assess the risk to the housing market in Canada. And last quarter in December, when they released this report, there was only 2 cities that were at high risk as far as CMHC was concerned, and this quarter there's 5. So stay tuned to this video to find out which 5 are now considered high risk by CMHC, and I'm going to delve into this report and talk about the details of it and what it means to you. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you see this video. And don't forget about our race to 10,000 subscribers. Absolutely mind-boggling numbers right now. We're growing at a rate of 3,000 subscribers a month. Thank you to everyone who has joined us in the last 28 days and to all of you who have joined us in basically the last year of this journey. I really appreciate each and every one of you. Go ahead, click that subscribe button. One lucky subscriber is going to win their monthly rent or mortgage payment for a month just for subscribing to this channel. So go ahead and click. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss CMHC's housing market assessment for March of 2021. As I said in the intro to this video, this is where CMHC describes the housing risk that they see in the Canadian market. They go through on a city-by-city basis and basically look to each of the individual economists in each city that CMHC has on staff to sort of determine what's going on in each individual market. And what you'll notice is that they give us last quarter's ratings and this quarter's ratings. And basically what we're going to do is we're going to go through and take a look. So let me jump right over here, and we're going to scroll right down to the first chart that is really interesting. And this is the comparison of the data between December 2020 and March 2021. Now, as you can see, it lists out all the major cities in Canada. It lists out four different things that they look at with respect to assessing vulnerability, and then it gives an overall assessment for the market. And what I'm going to do is I'm going to give you the full screen here, take me out of it, so you can see what's going on in each individual city. Now, if you go through and you take a look at here, basically it's pretty simple to understand. It's basically red light, green light in this scenario where green light means that there's low risk and red light means there's high risk, and yellow light means that there's moderate risk. And what you can see just looking at the overall chart is there is a lot of markets that don't have very much risk right now. You look at the St. John's of the world that has very low risk across the board. Winnipeg showing very low risk across the board, although I suspect that in the next quarter these numbers are going to change as the overall market in Canada heats up. And then you look at different places like Vancouver, which shows very literal vulnerability in everything except for excess inventories. Now, don't get confused by excess inventories, because what this means is not that there's excess inventory, so lots of inventory. That would mean there was less risk in the market and there was more houses that were more affordable. But what this means is as it gets to yellow and red, it means that there is less inventory and therefore it is at higher risk. So you look at Vancouver, and the only thing that they're saying is wrong in Vancouver is that there's excess inventories. And then you go and take a look at a place like Calgary, where we are seeing multiple offers pretty much across the board. And we are seeing, in that area here, so if you go and take a look at it, I will basically put my cursor on it. They're saying that there's very low inventories. Now, this is where it gets interesting. And if I have a piece of criticism for CMHC's housing market assessment, it's that it is based on assessments from different economists in each city. And what that does is it creates an issue with this report, because the issue with this report, even though they're basing it all on the same criteria, what the issue with this report is that basically you have a whole bunch of different economists who look at the world through different lenses. And that's one of the things that you need to know about economists, and you need to know about the way they look at the world, because how they look at the world typically determines their outlook and their predictions. So if you look at somebody like myself, I'm a fairly positive person when it comes to economics. I believe in long-term growth. So my assessments are typically a little bit more on the positive side than on the negative side. Versus if you look at different economists out there like, let's say Benjamin Tal looking at interest rates right now, he's got a little bit more of a pessimistic view on inflation and interest rates. He's had this for the last 10 to 15 years, in my opinion. That's my opinion, by the way. I think Benjamin Tal is a phenomenal economist. He's somebody I look up to, but he generally thinks that interest rates are going to go up. So he has a little bit of a negative view. Now, when you look at excess inventories and you look at the inventories in different markets, is Calgary at a higher risk from an inventories perspective than, say, Toronto? I doubt it. But, it's being the Toronto economist and the Calgary economist are looking at things through a slightly different lens. So, when I go through and I take a look at these numbers, and I really, what I want to look at is I want to look at the cities that have changed. So the two cities that had high risk with respect to the real estate markets back in December were Moncton and Hamilton. Now, these still have high risk. There isn't much that's changed in both Hamilton and Moncton's risk reports here. But what I'm more interested in is I'm more interested in these three cities that have changed from moderate risk to high risk. So Halifax has gone to a high risk overall assessment according to Cmhc, as has Toronto and Ottawa. And for those of you who live in Toronto and Ottawa and are trying to buy a house there right now, you know that the markets are pretty crazy there. We know the markets are crazy there because we have a pretty significant amount of clients in both of those cities. And it's pretty much you write an offer, no conditions, and you basically hope that your offer is accepted over the 25 others. We have multiple clients out there in Toronto and Ottawa right now who have had multiple offers that have not been accepted. So it's something that's that clearly those markets are at risk because there's so much explosive growth. Now, this doesn't mean that CMHC is predicting that these markets are going to go down in value. What it means is that CMHC is basically looking at these markets and going, okay, if there's risk anywhere, where we have to look at the risk is in the ones that are red, and we need to watch the ones that are yellow. Now, if you go and you look at Vancouver, Vancouver's one that interests me. I can't believe that Vancouver isn't at an overall risk higher than what say a city like Calgary or Edmonton is at. When you look at Saskatoon, zero risk across the board. Hamilton, high risk. Hamilton, like Calgary, is a cyclical town. It has a lot to do with the steel industry, a commodities industry, similar to the oil industry in Alberta. So, when you see a market like Hamilton get things like, yellow marks for overheating and price acceleration and overvaluation, well, yeah, that creates a lot of risk. So, if I was in Hamilton, I'd definitely be watching those markets. And if something changes in the steel industry, I would definitely be, thinking about whether or not I should be investing in that town. And then, just kind of going in and looking at Quebec here, look at Montreal. They've got some overheating issues, some price acceleration issues. What's really interesting is all the price acceleration, right? This is where the markets where people are moving, buying bigger houses and whatnot. And I think that's the number one issue that's causing the market to have more overall risk is this, overheating and price acceleration. That anything that's yellow there, if any of those start turning to red, I think we really have to watch those markets closely. Now, I want to scroll down a little further into here. I will link to this report in the description below, but you can go through and you can basically look at the overall assessment here. They give some interesting graphs. Evidence of overheating in Canada. This is sales to new listings ratios. So you can see back in 2002, 2003, this went above the threshold. So this indicates that the market's overheating. You can see where it's at now. So obviously there is more sales than there are new listings coming onto the market, which creates that demand and creates that price increases. If you go and you look at this other chart here in the low evidence of price acceleration, and you look at their test statistic and their threshold, you can see that the evidence of price acceleration is starting to climb back up. Obviously, back in 2016, it was there. I suspect that by the next quarter, this number is going to be quite high, and there's going to be quite a bit of evidence of price acceleration across the country. Taking a look at excess inventories in Canada. So this is, this is lots of inventory. This is not a lot of inventory. You can see the inventory levels are starting to come back down. Pretty similar back to levels in 2006, 2007, where we saw a run up prior to the subprime crisis. And then purpose-built rental market. You can see that there was a pretty big vacancy rate back in the day here in the 90s. you can see that the vacancy rates came down, and you start to see that vacancy rate climbing for purpose-built rentals, which I think is an indication that people who are renting are moving into owning home ownership. And that seems to make sense because when you see lots of people flooding into the market of home ownership, you would expect rental vacancies to go down. And then just to kind of give you guys an added view of this, you can go through and look at each individual market and each individual economist assessment and look at, their comments with respect to different markets here. I'm going to scroll down to Calgary just because that's where I am and it's the market I know the best. Michael Mack, senior economist or senior analyst, economics. This is the one I'm interested in, is his comments with respect to excess inventories, because excess inventories show evidence of a high degree of vulnerability compared to a moderate degree in the previous quarter. So basically what I think he's saying there is we have way less inventories than we had in the previous quarter, and therefore in Calgary we're going to see an increase in probably prices and some overheating over time. So that's the CMHC housing market report, or housing market assessment. I think it's an interesting assessment that comes out. It comes out every quarter. It only really hits the news when markets are starting to see high levels of risk. And the reason why CMHC looks at risk assessment is obviously because they're an insurer and they need to know where their risk levels are, because that will dictate what their underwriting practices look like and who they're providing mortgages for and how stringently they're looking at different properties. When you see an area that gets into a high risk category, you may see CMHC clamp down on their underwriting policies. They may ask for bigger down payments. They may do things like look at condos a little bit more carefully. And anytime a market gets in that high risk category with CMHC, you can pretty much rest assured they're going to have a lot more due diligence when it comes to insuring mortgages in that area. So not a price prediction, not a prediction on where the market's going, but a prediction and assessment on risk. I think these are great reports. CMHC, I think, needs to be careful right now, because the last year they've been very, very bearish on real estate and been proven wrong time and time again. I don't think that they're necessarily going to be wrong in the long term on their predictions. I don't necessarily think they're going to be right either, but I think what CMHC needs to be careful of is what they're putting out into the market, what they're putting out as press releases, and ultimately what they're saying about the Canadian housing market as a whole, because obviously they need to be a trusted voice, and every time they put out a report that's negative or that's wrong, ultimately leads to a lack of trust in CMHC, and they need to start rebuilding that after the last year of basically criticism in the market and Evan Siddall going out publicly and attacking realtors. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. Don't forget about our race to 10,000 subscribers, and we'll see you on the very next video. Cheers.